Hey, what's up, BYOB Money Multipliers? Welcome to another week of the Ask Me Anything Happy Hour presented by the BYOB Money Mentor team. We're here to answer all your questions. So let's start getting those over in the comments. Let us know what you are curious about when it comes to infinite banking, becoming your own bank, real estate, equity, one pot system. We got Joe Helock in the house. We got Kevin here. We got Tess, Brian, Linus, Jason, myself. We're going to answer all your questions. But we'll do a quick around the horn, introduce ourselves if you're the first time here, and get your questions over in the chat. But we will be right back to get this show rocking. All right, here we go. So hopefully everyone's having a great day. We had a fun What the F this morning, talking about the State of the Union. Of course, Wealth Webinar dove into using the vault to pay off debt and the power of the infinite banking concept when paying off debt while still building wealth. So hopefully you got some value out of that. If you missed the Wealth Webinar today, the recording will be on the YouTube channel this Saturday, YouTube at the Chris Noggle. Make sure you're subscribed so you never miss any new content that's put up there almost daily. But I'm hanging out down here in South Florida myself. A beautiful day outside today. Dropped down, actually got down like the upper 30s, lower 40s the last couple nights, which is freezing for this time of year. But nonetheless, the days are beautiful and it's warming back up. So all is well in the world. Outside of that, hopefully everyone enjoyed the Olympics, the closing of the Olympics. I know I had a good time watching the hockey teams win gold, especially the men's team beating Canada. First gold medal for the U.S. in 46 years. Really cool stuff. So rocking my Team USA hockey hat all week in honor of that. Let's see. I'm headed over to Tampa, Florida tomorrow. I'll be at a real estate meetup event in St. Pete. So if you're in the St. Pete area, Tampa area, tomorrow night, you want to hang out, just shoot me a message. And then I'll be at Money Game Live VIP Friday. And then the main event starts Saturday morning. So if you're in the Tampa area, VIP is sold out. There's still a couple seats available, I believe, for GA. So if you want to come to that, give me a shout and I can try and get you a ticket. Other than that, I'll shoot it over to Brian Fouts. What's up, Brian?
I'm going to hop in a car and go join you. I'll see you in about 3 days.
You might miss it. So, maybe next time.
That's a drive I have never made before. That's a long one. The longest I've gone is from Washington to Louisiana. That was a long one. But yeah, Brian Foucher up in Pacific Northwest, up in North Idaho. And funny you mentioned it's getting warmer. Like we really haven't had a snow this year, but it's still really cold. And that got driven home here this Sunday. So this Sunday I'm out we're in the living room watching TV with my wife and the kids are in bed. Something feels wrong. Then I'm talking to my wife. I go, something doesn't feel right. What's going on here? And I realized our furnace is blowing. The fan will turn off. We're out of propane. We have no more heat.
Oh. So
from Sunday till this coming Friday, we have no heat in our house. And it gets down to 20 degrees at night here. So my kids are not very, they don't like it. They don't like it. But yeah, my office is the only space that has heat in our entire house. So I'm like, I know where I'm going to be at. So we have no heat for our house. Kind of interesting. So my kids are getting used to that right now. But yeah, kind of fun. But with that, I'll kick it over to Tess.
Hey, I'm Tess Hulek, and insurance has just been that thing I've loved for my entire life, mainly on the inside. I spent over 30 years inside the four walls and then decided it was so amazing I had to join you guys on the outside. As far as snow here, we had quite a bit this year, but we're to that point in the season now where every day, I hear feedback. Every day we end up with green grass, and the next morning we end up with snow again. So I will pass it on to Kevin.
Hey, thanks, Tess. Hey, Kevin Krause from upstate New York, few hours from Joe and the team and Chris. And super excited to be on, answer any questions. Obviously talking about money, infinite banking. Been doing HELOC since 2013, infinite banking for about 4 years now. We love talking about debt. We love talking about investing, anything like that. Obviously a shout out to everybody who was involved with the Olympics. Outstanding job. As Steven said, that game was amazing, super fun watching that. That one block by the goalie there to save the game right there was outstanding and amazing. So if you didn't see it, definitely check that out, because that was definitely the save of, I don't know, 50 years, right? Or since 1980, since they were in Lake Placid, New York. And if you didn't see the movie, The Miracle, that's definitely a great movie to check out, to kind of wrap things around with that. But I will now pass it on to Linus.
Thanks, Kevin. Hey, everyone. Linus Nolt here from Hopkinsville, Kentucky. Definitely happy to be here and help in any way I can, help answer any questions and give context, give insights, whatever I can do to help. Here in Western Kentucky, I don't even know, is it 50-something degrees, no sun. I haven't been outside today. But yeah, I'm certainly having fun helping lots of people figure out and understand the infinite banking concept, and if it makes sense for them to move forward. I help a lot of people with their applications to go through underwriting and get approved. So that's my everyday work is helping people get approved for policies. So yeah, that's where I have a lot of knowledge. But yeah, I will pass it on to Joe.
Thank you, Linus. So on HELOC, Joe, guess what I specialize in?
Mortgages?
Been doing HELOC since 2009, real estate since 2000, private money lending since 2013. Been on the team with Chris since 2018 with Chris. And every day just taking calls, helping people strategize and moving their money and being efficient and utilizing it, and bring on the questions. Down to my buddy Jason.
Thank you, Joe. What's up, everybody? Happy, what day is it? Wonderful Wednesday, hump day, right? Hump day. Excited. Like Snaggy said, it has been cold in Florida. It was in the 30s yesterday, 40s today. It was actually, I had conversations with people in Idaho, Wyoming, Montana, and it was warmer in those states. That's just not right. So, but it'll probably be back to 91 degrees here soon. So all good. Bring your questions. I see there's not a lot yet. We're here to answer them. We're always excited to be here. Learn things from you, learn things from us. Let's have some fun.
Yep. Let's go ahead and get those in the chat box, any questions you guys got. But with that, we'll go ahead and tackle the first one we got here from Power for Change. So he says, Primerica says, ditch the whole life, buy term, and invest the difference in a mutual fund instead. Said he explains there's no cash flexibility or cash value. They say you have cash faster. What say you? So my 2 cents on this one is, who at Primerica is saying that? Because I cannot imagine unless you're talking to a financial advisor, they should not be saying that. Because they're, in my opinion, they're giving some financial advice there. So Power of Change, first question I have for you right back at you is, who is saying that? There's
a definite delineation between this belief and that belief. And I mean, there is a white paper we have that people smarter than me, Craig Yenny, put it together. We can show you the math on it. You will still tell me that that's not true. So I'm going to say there's multiple solutions for multiple people. Here we're talking about whole life. We want things that are guaranteed and that aren't tied to anything else. So that is where we're going to stand. And that's the kind of answers you'll get from us. I tried to have a conversation based on a book I read, guys and gals, Tess, where during the book, these two guys start arguing. It's Green Lights by Matthew McConaughey. They start arguing about this woman of the night who walks in, and they're saying she shouldn't do that. It's against her religion. And the other guy's, well, it's her body. She can do what she wants. And so they're arguing heatedly back and forth. And finally, McConaughey picks a side. And he's like, I agree with so-and-so. And the guy he was disagreeing with got super mad and yelled at him and said, Matthew, it is not about whether you agree or you disagree. It's about, do you understand? And so what I would try to offer anybody is try to understand both sides, try to figure out what you're solving, and then go with that, because there's not going to be a wrong answer once you believe it.
It's 4:30 on that.
Power for Change. I like to give personal examples.
Yeah, you can talk.
I actually had a client who was ready to get a policy and then talk to somebody at Primerica. Well, what was her purpose? She had $50,000 in credit card bills, and she wanted to stop paying that 28%. So we got on a Zoom call. Actually, Chris got on, I got on, everybody was there. And the person from Prime America stated exactly what you said. Get term life and put their money into a mutual fund that was at 12% annual, blah, 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 for 15 years, this, that, the other thing. So, Power for Change. What happened to the lady's credit cards? Is she still paying that 28%? Is she now taking her money and putting it to term insurance, which is a bill, and 12% in the mutual fund? I don't know how you do math, but that's less than 28, isn't it? So how is she going to pay off those credit cards if that was her reason for doing this in the first place? It has to be with a purpose. She then hung up the phone, told Prime America, I don't want to work with you, came back with us, not only got a policy for her because I solved her problems. We put in the $50,000 as a dump. She took it right out, paid her credit cards, and as soon as that happened, then she got another policy for her husband and 2 kids because she understood the power of moving the money and paying themselves first and putting it to action. Now they can use the same dollar twice. So when you find out what the purpose is while you're doing this and understand the difference, you wouldn't ask that question.
Yeah, and the other response to that one is that, you know, we have a lot of clients, and yes, we've worked with lots and lots of clients that have done the whole buy, term, invest the rest. And I'll be honest, fast forward 5 or 10 years down the road, they are 9 times out of 10, in my personal experience, based upon the conversations, they are not where they want to be. They're kicking themselves in the butt because of what they did, and they're like saying, "Crap, I wish I had done something different." It's personal experience, but once again, if it accomplishes your goals, that's the right path. That's the real answer. If it accomplishes what you're trying to solve, create, whatever the best strategy is for that is the one for you. But we haven't seen that one be the best. So I'll just be honest. So with that, everybody, go ahead and get those questions in the chat box. One thing I want to bring out to everybody here is because we have quite a few people on these things every single week. If you're new, if this is your first time actually being on this, feel free to put something in the chat box, say hi, all the kind of stuff. We always like to see how many people we have that are new to our campfire, new to infinite banking, or just new to our group, because we do have a lot of existing clients that are on these calls. A lot of our clients come here every single week. They ask questions repeatedly, different questions, because they're going through the process of using their policy, and they have the resource of us, and they come here and ask questions live. So the more questions we have, the more we all learn. So go ahead and get those questions in the chat box. All right. So that being said, we do have one that it's a private question that came in. This is going to be a multi-part one that came in from an existing client. Correct, Linus?
Yes. I mean, she has some whole life, but is mostly new to the infinite banking concept. So it's kind of a bit of a transition time for her.
Okay. So everybody, especially if you're new, go ahead and put in any questions you can think of in the chat box there, in the comment box, so we can get those things addressed. But I'm going to take this one. So this is a longer one, so I'm going to take it in a couple different parts. So this is from Denise, and it says, about to do a 1035 exchange. So first off, what is a 1035 exchange? So a 1035 is like a 1031 exchange in real estate, where you're moving funds that are potentially taxable. You're moving them from one bucket or vehicle to another one without any tax consequence. So in life insurance, a 1035 exchange is where you're moving the cash value from an existing policy. It just has to have cash value, by the way. That could be an IUL, a VUL, which is indexed universal, variable universal, whole life policy. I've even done it from ones that are not mutual funds, because I've owned those kinds of policies. We're moving that cash value from that policy to a new one that is typically infinite banking. All right, so about to do a 1035 exchange, and the non-infinite banking policy, it has $5,000 in cash value. So her existing policy has $5,000 of cash value. It's not an infinite banking structured policy, can still have cash value. I was wondering what each of you would do with the extra $5,000 in a savings account. Would you add the $5,000 from the savings to the $5,000 in cash value from the non-IBC policy to the total $10,000 dump in for a new infinite banking policy? So let's start with that question first. So once again, $5,000 of existing cash value. Sounds like she's going to open up a second policy, and she's asking, what would we do with that money? Would we put it in savings account, or would we add it? Oh, actually, no, wait. Linus, is that money in a savings account or is it still in the policy?
There's 5,000 in each.
Okay, so 5K in savings, 5K in the existing policy, opening up a new policy and trying to consider how to fund that with a large amount in upfront.
Fouts, I got a cool idea.
Yeah.
Since it's a multiple part question, how about you read a part of it and then pass it to Tess, to Joe, and we'll go multiple part and then back to you for your take as well.
Yeah, so that's the first part right there. So whoever wants to take that one, raise your hand or speak up. Who wants to take that first part right there?
Read it one more time. What's the question?
Okay, so 5K in savings, 5K in the policy.
Mm-hmm.
Would you add the 5K from savings to the 5K in the savings to create a total of a 10K dump in for the infinite banking policy, the new one?
Oh, that's the one that she's 1035ing the existing 5,000.
Yeah, so there's 1035 potential of 5K in existing, 5K in savings, opening up in a new policy. So would you put the total 5 plus 5 equals 10 into the new policy, or do something different with the 5K in the existing policy?
I'd want it all in a policy myself.
Absolutely. If you have money on hand, why wouldn't you want to run it through the policy?
And keep in mind, you'll have access to about 90% of it. So you might want to run the math if you paid off something that was $5,000 and recaptured some more interest there. Yes, it wouldn't be growing for you, but just kind of look at what is going to be the best outcome for you. Or some people might just want $5,000 in go money sitting there. So,
because it is that and asset. If you get it into the policy, and like you said, then you can take it out and use it for something else.
Yeah, because so the way I'd answer that one is there's a short-term benefit and a long-term benefit. The short-term benefit is you can do something instant with the 5K, whether it's in the policy or the cash, that 10,000 total, I guess I would say, do something instant with it. Pay off debt, put it back into a HELOC, knock the interest down, all that kind of stuff. But you lose the long-term benefit of that money working for you for the rest of your life. So for me, I've made a lot of financial, I'll just call blunders, and I've learned a lot of lessons. And in almost every situation, it was the short-term benefit, except for about two things I can think of, but they were all short-term benefits, and I sacrificed a long-term, and I lost both, by the way. So I would lock it in for the long term and then address the short term second. Okay, that's how, so do both if you can. Lock in long term and then address the short term, but the short term might take a bit longer to take care of. But
I refer to that as walking over the $100 bill to pick up the quarter.
Yep. There you go. All right. Yeah, good one. Second part of this one is okay. Put it towards, or this is kind of a question. Put it toward the balance on the HELOC at 7.5%. So the question is, she's asking is, if I'm gathering this correctly, is take that 5K, put it towards the 7.5% HELOC, or put it into the policy. So the instant, well, Joe, I'll let you take this one to start with.
That's a both.
Yeah, I was going to say the same thing, but yeah, I'll let you take it.
As soon as you take your money and you run it through your IBC policy, when you take it out and borrow it at, say, 7%, and then the dividend comes in at 5%, it's technically only 2%. So if your HELOC is more than 2%, you said 7.5%, why wouldn't you want to store your money inside the HELOC to knock down that 7% rather than the 2%? So you could do both at the same time.
His and asset. Pick up that $100 bill and that quarter.
Jason and I did a video that time. And
asset.
Yeah. Because there's another way to look at this too. Yes, paying down the HELOC at 7.5% is going to save you in interest. It is going to save you whether you put the money into the HELOC first or put it into the policy first, then pay down the HELOC. Either way, there's going to be interest you're going to incur. That's versus just cash. There's no interest there because it's just gone. But the future value is gone of that money as well. So in the way that we look at this, we'd rather, be responsible for that money, pay it back with some interest, but then have that money growing for us so that instead of, having zero down the road, we'll have 5,000 plus the growth we've had. So 5 years down the road, the 5K might be worth $7,000 now. Long-term benefit, right? Versus the short-term gain. So that's where I look at it that way.
It also depends on what's next. What is she doing with that money after it goes into the HELOC? Are we putting it into an investment? Are we what are we doing? I mean, I say not enough info yet.
Yeah, I was going to
I
say.
like.
Oh, sorry, Brian. Go ahead.
Well, I'll get to the third part. So if you're answering this one, answer it first, then I'll get to the third part.
Yeah, what I was going to say is I'd like to hear a little bit more, right? She talked about a second lien HELOC. How much actually equity does she have in her house? Maybe she could get potentially a larger HELOC, right? To be able to do more with it. You know, potentially, I don't know what her goals are. Is she only literally looking at this only like a 5K, like that's a kind of a smaller size policy. You know, is it a good policy? Absolutely, depending on what her goals are. But if she's got this 20K HELOC, well, if she's been, I don't know how long she's been doing it for, how much equity does she have in her house? Maybe she could potentially get rid of that to go to the first lien. So she's got a larger pot, then potentially make it a bigger or a larger policy to be able to do more, whether it's investing, whether it's getting rid of the house debt, right? We talked about the 7.5%. Obviously, the policies are more in the 5-ish range. You know, there's one company that's talked about being in the 4s. So I think we definitely, you know, from a short-term perspective of just, okay, you got 5 saved up. I think that's more of a feel good. Hey, maybe that's like liquid money to use for some of her bills, you know, that she kind of has to the side that she kind of keeps there. But then if she continues to put in, you know, more money into this 20 HELOC, hey, yes, that's a small pot you could use. But if we look at it for more of a holistic and a larger approach, we might have more options for her, and she might actually appreciate a lot more to be able to do more.
Yeah. Yep. The third part of the question here is, you know, she's just asking for different scenarios, because the second part is, or keep some portion of the 5,000 in savings for emergencies. So I know exactly what pretty much every one of us is going to say. Savings is just a place that you put money, so it's there for the future. Where that savings is the actual decision. And I'll let someone else take it, because I know what we're all going to say.
Well, and I'll say for sure, because this is what I did in the very beginning, that if I could undo it, I would undo it in a heartbeat. But I actually we were in lockdown, and I took my emergency fund, funded a policy, drew the money out, and put it back in a savings account. Biggest mistake. I should have left it in the, because you know what? It was lockdown. This Chris Noggle guy had to be a scam. I still didn't believe it. So I literally made payments into my policy for a year. If I could undo that, and it took me guys 5 years before I admitted that to anyone, because it would have served me better to stay inside that policy, because it would still have been available. They turn around loans so quickly. I could have got it as fast, if not faster, than from the bank. Yeah.
And just so everybody is aware, so when we say emergency funds or emergency reserves, all that means is a liquid asset or liquid cash you have that could cover essentially 3 to 6 to 12 months of your basic expenses. So if you lose income, something happens, you have that reserve to go make sure that you can cover all your bills for 3, 6, or 12 months. Obviously, 12 months is ideal. 6 months is typically where most people are at. But what is the cash value in a policy considered? It's a liquid asset, by the way. Yep. So I have clients that do this. What does the money do in a savings account for you? Nothing. In fact, it's not working for you. It's working for somebody else, the bank. The bank is using your emergency reserves, by the way, to go create more inflation, if you want to call it that, but create loans for other people. So what a lot of our clients will do is they'll take that emergency fund, put it into a policy, and then just not borrow that portion of it. It's still liquid. It's still there. You can get it within 2 to 3 days when you need it, but it's now working for you. It's growing. It's protected outside of the banks, because the banks is not protected, in my opinion. It's protected, it's private, and it's there for you. So,
and it's making interest that you don't have to pay taxes on.
All the above. Anybody else?
Oh, yeah. First of all, if you have a HELOC, you shouldn't have a savings account, because your HELOC is your savings account, your checking account, and your investment account if you're utilizing and be efficient with your money. That 1% that money is making you in the savings account, and you're still paying 7% in the HELOC. Does that make sense? Why do you want to make 1 when you're spending 7 every month? If you take that money out of the savings account, put it into the HELOC, what'd you just do? You just increased your cash flow by 6% a month. Congratulations.
Yep. So And then I think Linus, I think that's all of it right there. Yeah. So she says the rest of the question here. I guess I should probably hide this existing comments. I didn't realize this was still up. So the last thing she says here, she's looking to build up cash value in order to invest it as our income has taken a hit recently. So, I mean, you kind of answered the question right there. If you're looking to build up cash value, well, then that's what you should be doing with the dollars that you have if that's your goal. Now, once again, if your cash flow has taken a hit, not financial advice, but just be very careful about needing your policy to create cash flow. So like I've had this happen before, and this is my personal way I've done it. I'd like to hear from everybody else here. I've had a client who says, hey, I want to do a 100K dump in or a 50K dump in, some large number. They can say, I can do this premium, but the minimum, but I have to have this dump in. I need to be able to borrow back out, and I have to go create cash flow. Otherwise, I am not going to be able to pay my bills in 6 months or 12 months down the road. I need to create cash flow. What do you think I told them about infinite banking?
That sounds like a horrible idea, Brian. That sounds like a horrible idea. It's like my favorite t-shirt, but I would say, I start asking people this, hey, do I have your permission to be direct? And I tell them, I don't think everyone should practice infinite banking. And then I say, what I've noticed after 4,000 calls is people don't have money problems. They have money patterns. Are you willing to honestly look at your money patterns to see if they're serving you or if they're working against you? Because what you just said, Brian, was a disaster waiting to happen.
Yes, 100%.
Yeah.
So that's what I told them. I said, hey, they really wanted a policy, but I said, it's not going to be me that writes it for you. Because what the challenge there is if they don't create the income that they want, then they're not going to be able to pay the premiums, their deposits. They're not going to be able to repay back the loans, and the policy is going to potentially be, at risk, which puts them at risk, the insurance company and other people at risk. So we don't like risk, and so we're not going to put the client at risk, even if they want to, because there's a whole domino effect to that thing. So that was not an option for them. So
yeah, and Brian, to your point, I'm glad you led them that way. Another point with this would be is I've had many conversations with people who think banking isn't working. And when you start digging into why they don't think it's working, it's typically because they've taken what has gone in, the liquidity they've built up. They've gone out and made multiple investments into different things, or maybe one big investment, and that thing doesn't work out. It's not cash flowing. And maybe they lose all the principal, or at least it's locked up for a period of time. Like I talked to a guy the other day where his money's stuck in a real estate deal, building a multifamily for the last 3 years. And it's, all legal, and he's getting the feedback. And so that's the part when, if you need that money to live your life and you're leveraging it that way, you're not following the principles of wealth.
No.
You're trying to get rich fast. You're trying to make things happen too quickly versus putting more value on yourself, slowing down, having more liquidity, and really following the laws of wealth in that manner. Because it can get it's not a banking problem a lot of the times, because that's just a system. Are you following the system? Are you following the processes? Are you being an honest banker? But if you do what Brian's person said, hey, I want to put all my money into this. I need to take it all out, and it needs to be cash flowing within 6 months. Or I can't pay my bills. Well, that's a disaster waiting to happen, because one wrong thing and it falls apart.
Yep. Exactly. Okay, so let's kind of get into some of these questions here. And everybody, go ahead and put those questions in the chat box. I don't see a lot in here. So
we'll just make them up. We'll just make our own questions.
We'll you don't have.
I think there was another part to Denise's question as well, but we can come back to that.
Okay. So Al, hey Al, how you doing? Says, I was wondering what is the difference between an IUL and whole life policy, and what would be the best choice for a person that has just started with either one of them for his family to benefit more? Chris?
Oh, that's great.
You can hear the echoes.
Where is
it? I mean, who else take that one?
There's Kyle Bush and IUL, and
Yeah.
then that will teach you about IULs.
And for infinite banking, we never use IUL. I mean, that's part of our infinite banking practitioners program. We do not use them. But like Joe was saying, go look up Kyle Bush and 8.5 million, and it will shed some light.
Yeah. And, Al, I mean, all of us here have probably looked at dozens, if not hundreds of illustrations from IULs to VULs to whole life. I have out of 100 IULs, I've maybe seen a handful that I would say that actually does look okay. The rest, I would say, like, this is dangerous. It is ridiculous. I looked at 3 today, by the way, from a family. They had 3 IULs. If they keep those IULs for their entire life, most likely they will not have any death benefit at the end of life because the policies will implode. Unless the market performs the best it has ever in its entire history for the next 30 years, those IULs will lose value eventually and go to zero. It shows it right in the illustration. Very dangerous. Now, here's kind of my simple answer I give to people. So just imagine that like infinite banking is like a car. Let's just say it's a farm truck. Okay, it's a truck. Well, in order to go down the road or function, that infinite banking truck has to have an engine. Now, if you have a farm truck, would you want a 4-cylinder out of a Honda Accord inside of that truck? Absolutely not. It would not work and it could not perform. Also, would you want a V12 from a Ferrari in that truck? Absolutely not. You would not want that. You'd want the best engine, which in my opinion is a Ford V8, 351 Windsor, inside of that truck. That's what you want. You want the best engine for that vehicle. If infinite banking is a car, you want the best engine, which in our opinion is a whole life insurance policy, not an IUL, not a VUL, not something else. It's the best engine for the vehicle. So there's lots of videos that we have on Chris Nagel's YouTube channel that talk about this. And we've all done these things. So definitely do your research. Definitely look at his YouTube channel and go type in IUL versus whole life, and you'll find some fun videos to go watch. But yeah, we do not touch an IUL. And so for those watching, an IUL performance, which is the growth of the cash value and death benefit, is tied to an index of the markets. Do those go up all the time? No, they don't. They can go down over time. They can be volatile, which means your policy is volatile. The return can be inconsistent. With whole life, it's a lot more stable, secure, and it has a track record over 180 years. So we tend to stick with the best thing that has performed over time. So there you go. And also IULs have been around since
70s,
1980s.
80s.
80s, yeah. They became really popular in the 2000s, by the way. But an IUL was not even created to do what we're talking about here at Infinite Banking. It was created to compete with the high interest environments of the markets back in the day. So it was
And
not
really, and the actual person who takes the risk is the policyholder. With the whole life policies, the insurance companies are making guarantees to you. There's no risk to you.
Yeah.
I was going to bring that up. There is no risk to a whole life. And with an IUL, they put the entire risk on the client. Another thing is, if you're here to do infinite banking, who is the number one purchaser of whole life? Banks. So if you can tell me which bank puts their money into an IUL, none of them. It all goes into whole life, specially designed what we do.
One more time, in case you didn't hear what Joe said. You take on whole life, you have guarantees. It will guarantee work the way we showed you. Guaranteed contractual interest growth that's permanent as long as you're keeping your policy alive. Guaranteed level premiums. And when you're doing infinite banking, you're going to have an amount that has to go in. I call it a manageable floor. You're going to have a meaningful ceiling, meaning how much solves your problem or the opportunity. And you have a guaranteed death benefit.
That word, guaranteed.
Exactly.
Love that word.
And on the IUL side, you are assuming the risk. The insurance company is transferring the risk to you. It may work out the way it showed. It may not. It's on you. It is basically an investment grade vehicle when you look at it in those eyes, because you have no guarantees in that direction. Other than at some point, it's probably going to blow up because you're going to get older and your single year renewable term is going to get more expensive.
I still believe that if somebody hands in a IUL that performs as the illustration did after 10 years, I think they get $10,000.
Yes.
If I'm not mistaken.
10 grand.
Yeah, it's never happened.
That is how certain Chris is that it will not perform the way the first illustration was written.
It's probably close to 5 years that he put that out there. If anybody could get an illustration that.
Isn't that funny? Not one person yet. Isn't that amazing?
And all they have to do is show an illustration that's 10 years old that has a form like
That's
that.
it. Just show a policy of 10 years and you get 10 grand.
Yeah. I've seen quite a few that are over 10 years old, and not one of them is close to performing.
It's nowhere close.
Never.
And it was two people. It was Chris Noggle and Chris Kirkpatrick who went in on that.
Yeah, I think so.
So two practitioners.
And Devin Devin from our team. He's got a really good story, right? And I had one too. Obviously, I 1035 to end a whole life just to make sure.
How much was your surrender fee?
Actually, it was right after the 10 years, so I
didn't
have to worry about that. Yep. I waited just like another year or whatever at the time, so it worked out. But I like Brian's car analogy, right? Except for, just to add into that, the insurance company can go in there and just start messing with your engine whenever they feel like it. They turn up the dials, they can do different things, and it just, versus like, hey, if you're getting the chassis of the whole life, you know exactly what you're doing, you know exactly what it is. Nobody's going in there messing, turning up the rates, going down to the floor, potentially losing money. If you hit a 0 year, multiple 0 years, then you're definitely going to have an implosion for sure. So if you like the guarantees, that's where it's at. And Nelson Nash Institute, they're big on that. He talks about it in his book. He talked about the IULs or the ULs and where they came from, the history of things. So, but I would definitely, like myself and Devin, and I'm sure there's definitely other people, I thought it was going to be for retirement. And obviously it was definitely not talked about like it should have been, or used the way that it should have been. So now we know, we educated, got a part of the team, read 1,000 books, watched 1,000 videos, educate yourself, Al. That's all I can tell you. And you're in the right place if you're going to do that. But in that case, I got to go to basketball practice with my son. So you guys take care. Have a good week.
Have fun.
Later, Kev.
Thanks.
Have fun, Kev.
We haven't been saying that
right
word.
there.
We haven't been saying that word enough lately. Guaranteed.
Yes.
Yeah, I knew you liked that. Yes, I saw you light up.
I like that word. I love guarantees.
You brought out two blasts from the past. And guarantee.
There you go. Yeah, the and asset and guarantee.
Yeah.
You can't. I mean, does it get better than that?
I can't say it enough.
Yeah, I had someone ask me this question. They said, "Well, isn't the death benefit of term policy guaranteed as well?"
Until it lapses.
Until a certain period, until you stop paying the premium, yes. But the funny thing is that, yes, it is guaranteed, but you have to die during the first, the 20, 30, whatever the time frame is, to make the death benefit guaranteed and pay out. But it's not guaranteed to be paid out, at the end of life. If end of life is, 90 years old. That's
Brian, let's elaborate on that.
Yeah.
What is the percentage of term policies that actually pay a death benefit?
1.5% they estimate.
Yeah.
Thank you. What is the percentage of a whole life policy that pays out when you die?
Should be 100%.
Yeah, as long as you're paying the premium. Yep.
Now, you would not even have received that term policy if the underwriter thought for 1 second that you would not make it for that term.
Yes, it's kind of interesting. So, like, if you go and do the study on this, which I've done a long time ago on term policies, the ones that pay out, death is almost always it actually is. It's always unexpected.
Yeah.
Always.
It's an accident. It's a sudden health issue that was not you could not see it ahead of time. It's always something unexpected from my research.
Tess, I have a question for you.
Sure.
What is the number one asset on the P&L for an insurance company? Is it not term insurance?
Predominantly for the insurance companies I worked for, it was mortgage-backed securities.
Okay. But term insurance is their income.
Absolutely.
It's their income.
Absolutely. And like for all of their executives, they've got a lot of insurance on those as well. It's not the biggest piece, but it is definitely a huge piece.
Yeah. That's how they make money.
Cool. Awesome. Well, we're not seeing a lot of comments here. Where's everybody at today? Questions in the talk today.
I think that one was really good too, where he was talking about the PUA, that he wasn't understanding that PUA is purchasing death benefit, but it's also increasing your cash value.
Yeah, this was kind of in addition to that one. So Chad, the question here goes, but the dividend doesn't come to me. It goes to buy more paid up additions, correct?
Well, but what is the paid up addition?
More death benefit.
Is that not cash value?
Yes, because your more death benefit purchases more cash value. Yeah.
And isn't that what you're able to use?
Of course.
All right, then.
Guaranteed. You know. Sorry. I just love that word.
Yeah. So keep in mind, I mean, the cash value, which is what the PUAs are purchasing, the cash value is yours. Like if you can borrow it, you can cancel the policy and get the cash value out. You can permanently withdraw the cash value. I mean, it's yours to do whatever you want with. So the dividends do come to you in the form of paid up additions / cash value. Yes. And also the add death benefit. But no, it is yours, yes. But that there are more than one dividend option that can be chosen. For infinite banking, there's typically only one. But you can have dividends paid out as cash. They can go buy index. They can go buy you actually index returns, which I've never heard of a person doing that. Or it can go to PUAs. It can even be used to pay premiums, by the way, down the road. Yes. So that's why if you look at the illustrations that we build, you often see the premium go to zero at some point in time. That's because your dividends are large enough that they can go now and they can cover the premium. And now your policy is self-fulfilling or self-funding, as we call it. So lots of options, but yeah, mainly it's going to be the PUA option. Let's see, what else we got? Okay, so Chad has another question here. He says, you mentioned borrow at 7%, so that's the loan rate, but the dividend is 5%, so the real cost is 2%. My understanding is the dividend pays for more PUAs, correct? Not sure of dividend of cash. Am I missing something? So yes. So from a not even 30,000, from a 50,000 foot level, yes, 7 and 5, correct. But in reality, how it does operate and function, it's not that way. So I don't know if anybody wants to elaborate on that. So by the way, for everybody who's listening, what he's referring to is if you borrow at 7 and you're earning 5% dividends, your spread is 2% or negative 2%. That's what he's focusing on. But it's not a black and white situation.
Yes, you have to know what your money is doing. That's when we're educating this, when we're leading this part of the presentation. When I always talk about Jason being an honest banker. You're banking with me. I'm giving you 4%, right? Guaranteed test 4%. And you want to borrow the money from my bank, and I'm like, Tess, don't do that. I'm going to give you a loan for 6%. Am I telling you the truth that after 5 years, Tess, that you will make money growing at 4 and borrowing at 6?
Absolutely.
Yeah.
But you're going to tell me no, because 4 minus 6 is -2, guys. What are you talking about? Joe, you said earlier, if 1 + 1 = 3.
Yeah, but that's not the way money compounds, Jay.
Yeah,
but Chad, that is one of the common approaches that keeps people stuck. When we talk about money patterns, your question, and it's okay, but your question is proving why people are stuck.
Mm-hmm.
You have to understand what is happening, and it's pretty simple. When it's uninterrupted and compounding, it's going to have more growth because it's going to look like this, and then it's going to start going like that over time, right? These things don't get sexy till later. And then when you're paying down principal, your interest amount is getting smaller as you're paying that down. So you can actually make money in a negative spread like that.
And Chad, I'll give you an example. In year 4, I had $800,000 that I borrowed from my policy. I paid $38,000 in interest, received $35,000 in dividend. That's 0.375%. And when I moved that 800, I made an extra $300,000 on it. So do I really care about the 7, the 5, the 2? It's how you move the money and what you're doing with it and how it's making more money with it. I was able to put it through the policy and put it into an opportunity to make money in the policy and to make money in the investment. And if something goes wrong, I still have a legacy play because now my family still has a death benefit and I'm still able to use all the money.
Yeah. And one of the bigger kind of misconceptions on this analogy here is that these interest rates are specific and exact. They are not. Well, they are not actually. Just put it honestly, they are not. The dividend rate is probably one of the more complicated calculations that does exist in life insurance policies. if the declared dividend rate or dividend crediting rate is 5%, that does not mean your policy is going to grow by 5% every year, because they calculate the dividends it's a very complicated calculation upon, and every policy is slightly different. On the death benefit mainly is what it is, but how the cash value has been funded, the growth, all these things dictate how your policy is going to grow. And the longer you have the policy, the more efficient that growth becomes. It is an amazing thing. So you look at year one, you'll find out the growth and efficiency. Okay, it's this. 5 years later, wait a second, it's better. 10 years down the road, holy cow, it's getting more. It's growing even faster, even though it's only 5%, but now it's growing faster than that. It is awesome. So it's so you're comparing apples and grapes, not even oranges, apples and grapes, in my opinion.
Yeah.
Also, you've got to understand that the loan rate is an annualized rate, assuming you don't make any payments on a loan. It's 7%. But if you borrow $10,000 and 6 months later you pay the entire $10,000 off and take no more loans in that given 12-month period, it's not 7%, it's 3.5%. So you can manipulate the loan rate based upon how you pay back the loans and use the loans. The dividend just keeps on growing no matter what. So we've all used these policies, and this is one of the more common questions we get. But in our personal experiences, yeah, I mean, it's the opposite. It's you're going to make more, earning 4 while paying 6, as Jason said.
Hi guys, I gotta go pick up Ariana.
All right.
Yeah.
Tell her hello.
But this is a great question.
Yeah. Oh, easy.
Yeah.
Hold on, Brian. Before you go to the next question, I know we're getting close to the end, but when you were saying that, this popped into my head. I thought it was fun. If you came on here every Wednesday and listened to us, like some of you do, which thank you for being here all the time. Like Shauna's here all the time. Mama Bear, who's ready to come out of hibernation, she told me earlier today. So we're ready for it to get warm everywhere. But what I was gonna say is, I just imagine like a song. Like imagine AI going in and just taking the highlights. We say the same stuff over and over again. Like I'm literally listening when a question's asked. Linus will say the same thing. Joe, Tess, myself, Brian. But these are how simple this is. It's not like we have to come up with new stories to say the same thing. But imagine like a song that would just play like little beats of us saying the same thing over and over again. That'd be pretty funny, right?
We should create one, and then people can listen to it overnight while they sleep.
No, I just have ideas. Someone else has to go do that. I'm the
But
idea
Shauna
guy.
said that Linus needs to sing. Linus, you can sing our song.
That was only if there was no questions. Unless Linus wants to sing.
Yeah. Well, we got this one right here. Which kind of this question here, or this comment, actually dovetails onto what you just said. And this is from Tad, and he says, is it time well spent to customize an AI agent to utilize all this great info in developing a portfolio for investment, retirement, or money multiplying? At some point, yes, maybe, but you got to understand, where is AI getting the information from that is given to you?
Yeah.
That is not from experience. And if you're talking to like us, our knowledge and what we're experiencing is coming from education, from continuing education, by the way, and boots on the ground experience doing this ourselves. And I don't see how AI is really going to it's not going to create policies and all that stuff, because you have to be able to ask the right questions. So is AI going to ask you the right questions to create the policy and the structure and the strategy to solve your problem? Not today. It's not. No. Now, that all being said, can you use it to educate yourself? Yes, as long as you're asking the right questions. Now, why do I say this? And I'm going to give you guys this is a real example of what I did with a client. A client, this blew me away. They went to AI and they asked AI a question around infinite banking. They asked a couple questions and they got a response back. And that response said, "Oh, I'm not going to do infinite banking. It doesn't make sense now based upon the AI." And they told me that they're not going to move forward, and because they did some research. I immediately asked the client, I said this: "Did you ask AI?" That's what I asked them. They said, "Yes, I did." "What'd you ask them?" They gave me the answer, the questions. I typed in AI into one of the other AI softwares. I typed in the question that they asked AI. It gave me completely different responses. Word for word, the same question, completely different responses. Why is that?
It's almost like when the internet was new. In the internet, when I was in college and we had to start using the internet for our papers, you had to be really careful for the sources. Is it an EDU source that you're using in your paper? Because anything less than that wasn't credible.
Yeah. Now, why did their AI give different answers? Same AI software, by the way.
It gives you what you're asking for, and so depending what angle you're asking from, it's going to give you what you want to hear. In a sense, I've seen.
Well, no, it's
your history.
Well, it was the same exact questions. I don't know if what their account is, but what the AI is doing, it's looking at your prior questions on different topics, on everything. And it's saying, okay, I know what this person wants to hear. So I'm going to give it a response. I'm going to give this person a response that's going to make them happy.
Yeah.
Not the right response, but the one that makes that person happy. I believe that 9 out of 10 people use AI wrong because they don't know how to approach it and how to ask questions, because you should not ask questions.
You got to ask AI to stress test what you're thinking too, like start challenging you, because otherwise it's going to be rainbows and butterflies, and you think you're the smartest thing ever, and you think everything that you're asking is you got to go do that, and then you start doing it, and you're going to be surprised.
It does do rainbows and butterflies.
Yeah. Well, just try this. Ask AI, hey, here's what I'm looking to do. What are the best questions I should ask? Because otherwise AI is going to go comb the internet and stuff, but it's not going to actually work for the question, for the answer. And so, so I have people I listen to about this kind of stuff, and I've seen it actually in real time, and it kind of blew me away. So, so Tad, for what you're saying here, it's yes, but once again, based on what I just said, it's going to be very challenging for the average person. Now, a financial advisor could ask AI the right question to get the right response because they know what they're doing. That's the big difference right there. But what did we do? So what Chris and the team and Craig and all of them did with our software developers is inside our vault, we created AI, Chris Noggle. And so what this one does, though, it does not go out and comb the internet for the best answer for you. What it does is it goes and it combs all of our content, all of Chris's videos, all of our YouTube channels and social media that are all focused on infinite banking the way that we believe it should be done. And they're creating an answer based upon that knowledge base. Very different. And by the way, if you ever want to have fun, anybody, go into the vault, ask a question, and go ask the same question of AI outside of the vault. You'll get different answers. Very, very different answers. And so it's a good thought though. But I do know a lot of people are thinking, oh yeah, financial advisors are going to be out of a job in 5 years because of AI. I don't believe that. I don't. That to me is insane, because you're putting the control or all the responsibility in the hands of a person using a software.
And are they prompting it correctly? Because you're right. That prompting is critical. It's
very important. And so there's courses you can take on this whole thing. And I've seen people that use AI very differently than the average person.
Another level of this. And I just got to expose this to your point, Brian. So everyone's listening. If you're not using AI, or you're not at least being aware of how you can use it, you want to start for sure. I had someone who's a next level PhD thinker, and he has built basically AI agents that are going and working while he's sleeping, but he has them contained, but they're going and literally, if he's listening, I hope I'm doing him justice on how he does this, but it goes out and it listens to all of the favorite speakers that he listens to all, in all these different channels. And then it looks for similar story arcs said differently, and then what it does is it pulls those down, and then it tells him what they're not saying that it might mean. He's looking for this to not just to ingest more material, but he's looking at how can I take actionable steps to move me forward. And that's how I would offer using AI. Like, how can it be an actionable thing to help you figure something out that's going to move you towards your goal?
Yep.
Because I'll say one of our clients, Lori Halter, has been guiding me, like with the proposal I've been working on. Be careful on what you're asking, who you want to be pulling the information from as you compile this report.
Also, you want to hear something really crazy?
Oh, yeah.
ChatGPT. This is I don't know if I believe it 100%, but just be aware I've heard this. If you have a free account, your data is that you put into it, all your prompts, all your questions, everything. It's grabbing all the information and it's taking it public. So if you're in a competitive space and you're using AI to create, copy and ways to make yourself better, guess what your competitors are doing? If they're using AI, you're all feeding the thing to give everybody else the answers. It does that.
Wow.
If you have a paid account, if you go look at the terms and conditions on a paid account, it keeps your answers to you. It's not supposed to use them outside of your account. But I'm not sure if that's true or not, but I just heard that and I'm like, yeah, that actually makes a lot of sense. Because how does the AI software build itself and become better? By getting all of your responses and questions and stuff and further propagating the whole system. So yeah, just be careful. Be careful. Skynet is alive.
They always said garbage in, garbage out.
Yep. Well, cool. I think that's all of our questions. We're women over time. We only had a handful of questions today, but a lot of good information. So with that, everybody tune in next time and bring those questions here next week for another Ask Me Anything. Also, keep in mind, we do have a lot of live events every week. So we have about 6 events, this being one of them. Today, we have 3. We have WTF in the morning, Wealth Wednesday webinar in the, depends on what time zone you're in. For me, it's morning still. We have the Ask Me Anything, of course. And then we've got, Monday? What's the Monday one?
It's Money Club Monday. It's been
that one. Take Back Control Tuesday. We've got the Thursday one, and then we also have the Vault one that Craig and Marius are doing on Thursdays now too for the Vault software. So
I mean, breaking into the vault at 7 p.m. Eastern, usually every Thursday or every other Thursday.
Every other Thursday, yeah.
So stick around and get learned up on infinite banking. But with that, thank you everybody, and we'll see you on the next event.